Meanwhile, let's give you some perspective, though, on the market activity. And for that, I'm joined by Gilburt, who joins us from Nedbank Private Wealth to provide more perspective on the market dynamics. Grant, always a pleasure to have you with us, and thanks for making time.
Thank you, Vivi.
I feel like it's a Monday, Tuesday, but it should actually be a Friday. This long weekend actually really messed us up.
It has been really disruptive,
Yeah.
and I guess what we're seeing today on the local market is a bit of catch-up. So last night, some of these FANG stocks, which we refer to...
Facebook, Amazon,
Google.
Netflix, Google.
There we go.
Yeah.
So predominantly the technology stocks sold down quite heavily overnight. And that's why we're seeing Naspers under quite a bit of pressure today. And of course, Naspers is such a big component of the all-share index, so really dragging the index down. So a bit of catch-up, but the market is quite weak today, which is not something we've seen for quite a while, given that the market has been so strong and trading near its all-time highs.
Quite right. Market weaker by 1.5%, now at 54,984 points. So really pulling back quite significantly. As you alluded to, the likes of Naspers also seeing some pressure, weaker by 3%. But just on the FANG stocks, I mean, a few weeks ago we were singing their praises. Of course, valuations look a bit steep right now, but would this be a good time for someone who doesn't have exposure to some of those stocks to actually get in at these levels?
I think that's quite a difficult question because those stocks have done so well this year. I think they're up as a basket about 20 to 25%, so they've really performed well this year. So I think some of this weakness can be explained by profit taking. If some of those stocks, high beta stocks, gave me 25% in the year, I'll probably also be taking some profit. So I guess what you really should be looking at is the sentiment on the market, and I think currently the market is quite skittish given what's happening in the Korean Peninsula. So I would wait and just see if this bear market doesn't take it a bit further.
Yeah. The concerns regarding North Korea are quite significant, though. We do see it having an impact on commodities. Gold again still being seen as that safe haven asset, and the only sector actually performing better today on our local index. And of course the oil price also seeing some resurgence there.
I guess this Korean Peninsula story is nothing new, but I think what the market is trying to gauge is whether or not it is going to escalate. So we saw the foreign minister of North Korea coming out to say that America has actually declared war and that they would escalate and shoot down planes even if they're not in their territory. So I guess the market a little bit more nervous, reading that the situation might escalate. So of course gold, being a safe haven asset, is performing quite well. And then the oil price also reaching $60 a barrel, so quite a nice recovery. So a lot of these oil companies are saying that the market is far more balanced, and I think this speaks to OPEC's agenda with all their production cuts. So I think OPEC...
Would that be enough, though? Because I doubt it would take it back to 100, or could it potentially?
I think in the short term what you might find is that the price might pop up a little bit more, but given all the supply that comes onto the market, especially in a higher price environment, I think in the long term I'm still quite bearish from a structural perspective on the oil price. So we'll see OPEC so far is pushing the market a little bit higher, but they're also not the controlling stake in the market. I think the swing factor is really the US shale gas producers. So let's keep an eye on that. So in the short term, oil price might pop up a bit, which of course is not good news for inflation. But if you are the central banks in Europe and America wanting to get inflation going, this might actually help them.
I'd like to sidestep for a moment and get into the minds of some of your clients, because I can recall a few months ago internationalizing your money and really investing offshore was a huge theme for many South African investors and even some of your clients too. With all the noise that's happening from a macro perspective internationally, how do you now balance the conversation to actually say, well, look, we can take your money offshore, but the level of risk now, given the North Korea concerns, has actually escalated quite a bit?
Look, I think irrespective of what is happening in the market, it is still a prudent strategy to have some offshore investments.
Sure.
Of course, the investment universe is far wider than what we would be having in South Africa. So once again, you're not constrained and only forced to have a look at the equity markets. You can have a look at some of the other asset classes internationally.
So lots of more options available on the market. Just be careful as to where you look for them.
There you go.
Awesome. What about the Fed? Janet Yellen today as well expected to give a brief speech, and we know ongoing dynamics there with regard to conversations on the inflationary outlook for the US, and they're also expecting the revised second quarter GDP data later this week, Thursday.
I think the market was really surprised last week. She came out to be quite hawkish, and the market, as you know, wasn't pricing in any rate hike for the rest of 2017, where the market is now 60% expectation that they could be hiking in December. So really caught the market by surprise, far more hawkish than what we were expecting. And obviously if the oil price continues to trend higher, we could see inflation ticking up and giving them more reason to hike.
That again would be a good thing, but not really so great for emerging markets like South Africa, where our bond markets have actually been attracting a lot more FDI.
So I think the Rand and the local bond market have really benefited from flows, searching for yield. And of course, if the Fed starts hiking, it reduces the attractiveness of the South African bonds, and also could place further pressure not only on the South African rand, but also on emerging market currencies. And the dollar has been really, really weak this year. So I do think that we could see some type of recovery in the dollar going forward.
On the rand, though, 13.30 is how we fare for the moment. Again, from a Nedbank perspective, any expectations as to what range we might continue to see ourselves moving in? I think when we started September, we were at least in the high 12s, 12.80, 12.90, but we've seen a slow deterioration over the last 2 weeks.
Yes, I think it really is going to be dominated once again by the Fed and what's happening in the macro environment. We're still in a very low growth environment, so we're not really going to see support from the rand on that front. And of course, we are heading into the ANC elective conference in December. So I do think that we are going to see volatility increasing quite substantially going towards the latter part of the year.
Sure. Let's talk about that volatility coming through in some of the newspaper headlines as well at the weekend. And of course, some of the concerns are being raised regarding the PIC, state-owned entities. That must leave a lot of South Africans slightly uncomfortable with regard to the conversations that are taking place there. And hopefully, there's no truth to it.
It is very concerning, especially for those members of the Government Employee Pension Fund. But I also think if we take a wider look at this, we've got to ask ourselves, how will the rating agencies look at this? So the rating agencies have been saying for quite some time that the support for state-owned enterprises is definitely a concern. So I think not only is it a concern for government employees, the members of the public, but also the rating agencies will be keeping a close eye on this.
With that said, though, your view as to how best we need to manage this, especially from a ratings agency point of view?
Look, I mean, there are a lot of risks on the horizon, so I think that just obviously speaks to the benefit of diversification. I mean, we've already mentioned it once in the show, keeping some of your cash offshore for the investment purposes, and locally just keeping a nice balanced portfolio.
I also want to get your views with regard to what we see regarding Remgro and Unilever, a new deal there being struck, and it seems as though one exchanging assets with the other in order to get a stake in the South African firm. Give us a sense of how that deal actually works and who it benefits at the end of the day.
I think it's quite interesting because Remgro hasn't been very active on the M&A front, and of course as a holding company you're expecting to be quite aggressive on the M&A front. So essentially what they're doing is they had a 25% stake in Unilever South Africa, but I think that they felt that they didn't have any controlling power in order to make any strategic decisions there. So essentially selling their stake back to Unilever and buying their spreads business, which is, as we know, some of Flora and some of those Rama brands. So on a swap basis, it looks quite interesting because it seems like they're selling the Unilever stake at quite a high multiple and buying back the spreads business at a lower multiple. But I think some market participants could be quite concerned because Unilever was one of the only unlisted instruments and assets in the Remgro stable, and all of a sudden, if that disappears, you could find less justification for holding a holding company.
For Remgro, though, and for investors within Remgro, is this still a good deal, looking at the share price valuation? And as you say, they haven't been very aggressive in their M&A strategy of late.
I think the valuation makes sense, but of course it is a smaller percentage of the portfolio. If you really want to have a look at making a call on Remgro, you've got to look at Mediclinic and FirstRand.
Exactly. And those as well recently came out with some numbers that we saw. What about PPC? That also the company, as we know, lots of talk with regard to a potential deal with Dangote, which seems to be firming its hand on that particular deal, and an investor roadshow today. So likely questions that might be asked. I mean, individuals like you engage with these corporates on a day-to-day basis sometimes.
I think it's very interesting, but I think it just speaks to the need for some M&A, as we've seen. I mean, locally, the construction environment has been under a lot of pressure. And then, funny enough, I mean, the competitive landscape with Dangote also entering the market quite aggressively and reducing those prices. So I think it's going to be very interesting to see what does happen. They recently had the rights offer, so I think it just speaks to the need to shore up their balance sheet and obviously get that scale from some M&A activity. So hopefully something happens and shareholders are benefiting from it.
Well, let's certainly hope so. Before we let you go, though, Grant, it is the last week of September. We've obviously seen quite a lot of market moving factors in the third quarter of the year and since the beginning of the year. But what's your analysis of what dynamics have been with regard to market activity in the third quarter and how we need to prepare ourselves as investors as we reach the last stretch of the year?
I think the last month has really been dominated by earnings, so it's been quite nice to see and to take a micro view of the earnings that we've been seeing and being able to see how the companies have been able to hold their heads up given how slow the economy has been. But I think going towards the fourth quarter, we've got political risks, and once again I think the risks are going to start shifting towards the macro environment. So far less of a micro story and keeping an eye on the macro story.
Fantastic. Keeping an eye on the macro story. We'll leave it there for today, Grant. Always a pleasure having you with us, and thanks for your time. That was Grant Gilbert from Nedbank Private Wealth giving us an analysis of the market activity we see today. We're going to take a quick ad break. We'll be back.